Hello and good day everyone. I'm Fakrizzaki Ghazali, Head of Fixed Income Strategy at RHB Group. In this podcast, I will be sharing some ideas for investing in automotive-related bonds. Under the rising interest rates environment, it is always good to look for opportunities from the cyclical sector riding on the economic recovery story in 2022. As usual, fixed income investment could offer stable income amid rising market volatility from other asset classes. In our view, auto sector outlook to remain resilient this year. The Malaysia Automotive Association is targeting an annual growth of 17.9% in total industry volume to 600,000 units this year after 3.9% contraction in 2021. The key drivers for the sector include global economic recovery, sales tax exemption incentive for passenger vehicles until June 30th, 2022, and attractive financing costs that will provide additional stimulus for the industry. The association sees production and deliveries to accelerate to fulfill backlogs and new orders which will improve sales in 2022 apart from growing interest in electric vehicles. The downside risks are that the sector may continue to face supply chain disruptions such as the semiconductor chip shortages and higher logistic costs could pose restraint on growth in 2022. On the automotive market share, Produa and Proton will continue to dominate domestic auto sales with 59% market share in 2021, down from 62.1% in 2020. And on the non-national car makers, Toyota and Honda remain the market leader with market share of 14.2% and 10.4% respectively. The auto-related bonds in ringgit consist of market leaders with strong branding in the domestic markets such as Proton under PONSB Capital and the RB Highcom, Produa and Toyota under UMW Holdings, Nissan under Tan Chong Motor Holdings, and Mazda under Bermas. The highly rated issuers are secured by the corporate guarantee from the parent, such as Daimler AG for Mercedes-Benz Services Malaysia and Toyota Capital Malaysia by Toyota Motor Corporation as an ultimate support. Issuers with long-term franchise and strategic partnerships such as UMW Holdings for Toyota, Lexus and Produa and Bermas for Mazda, Kia and Peugeot are well capitalized with strong operating cash flows. We view strong shareholder support as key to provide cushion against the cyclical nature of the industry, while the downside risk from licensing is mitigated by the long and established relationships and solid shareholding structure between franchisor and franchisee. Automakers which have access to capital markets from both the debt and equity markets are another plus point. We see value in UMW Holdings Perpetual Callable April 2028 at 4.59% with a pickup of 109 basis points against the respective MGS, while Proton's PONSB Capital maturing December 2026 and December 2028 are attractive at 4.5 and 4.8% respectively, which will provide spread of around 120 to 126 basis points above MGS. We see valuation of the AA3 rated papers are sandwiched in between the AA3 and single A1 due to the cyclicality of the sector, but we take comfort from the strong parent company support which provides sufficient credit buffers. The highly rated AAA by MBSM for Mercedes and Toyota Capital are quite rich due to the minimal spread offered of only 50 to 60 basis points against the MGSs and likely to tighten as yields rise. After understanding the key benefits and risks on investing in auto-related bonds, investors could consider the following. First, auto-related credits are expected to remain resilient amid favorable policy support and attractive financing costs. Second, ringgit corporate bond issuers in the sector consist of established automakers with strong shareholder support. Third, better expected return due to the sector premium from the cyclicality of demand for motor vehicles and healthy operating cash flows. And finally, relative to equity, bonds can generate consistent income from semi-annual coupon distributions. Thank you for listening to the podcast. Have a good day and stay safe.